Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand strategies, insights, and tips to help you master the game of building wealth. Okay, today I'd like to talk about fixed interest rates, mortgage interest rates, of course, when to fix, when not to fix. It's a question we're commonly asked, particularly when interest rates move up or down, and they've certainly been pretty volatile over the last couple of years. But it's a fair question in terms of when to fix interest rates. And, many borrowers are tempted to fix when fixed rates are less than or lower than variable interest rates. But like with all financial decisions, the best answer is not on gut feeling. Let's base it on evidence. And so today I'll really want to unpack what a normal interest rate settings look like. How do we think about the RBA neutral rate? And I'll get into why that's important. It helps us, make long-term financial decisions. And then I'm going to delve into a couple of decades of data around fixed interest rates. And I've got some, what I think are really interesting insights to share with you. So I think it's good. Let's look at interest rates in terms of, where have they been? And that gives us a chance to sort of benchmark it or set some future expectations, if you like. And the problem, though, is average interest rates aren't particularly reliable because things have changed quite a lot over the last few decades. If you think in the early 90s, anyone that sort of lived through the early 90s recession will tell you, mortgage interest rates got to 16, 17%. And that experience has certainly, sat with them for a long time. Lending standards, indebtedness, all these sorts of things have changed dramatically. So looking at average interest rates over, say, 30, 40, 50-year periods doesn't necessarily give us a good reference point. Also, the mortgage market is a lot more competitive today too. So looking at standard variable interest rates, even say 10 years ago, isn't that comparable because interest rate discounts are a lot larger today. So the effective interest rate is therefore lower. So I think the good benchmark to go off is the RBA cash rate. And so what I suggest is let's think about what the RBA cash rate could be longer term, add a margin on top of that, today's margin, and then that gives you a sense of, what you should plan for in terms of interest rate expectations, particularly when you're making a long-term financial decision, such as buying a home or an investment property or any of those sorts of things. So the first thing we want to really think about is the what's happened to interest rates over the last period of times. The thing to consider then is household indebtedness, and I'm going to share a chart with you if you're watching this video, listening to this, or watching this on YouTube. I'm going to share the chart. If you're listening to it on a podcast, of course, the chart will be on the blog on the website, and like always, the link is in the show notes. And what it does is chart household indebtedness and the RBA cash rate. And so what you can see on this chart is that since 2003, so almost the last sort of 20 years, household indebtedness has doubled from an index perspective, and whereas interest rates have kind of been all over the place since then. So, if we look back over time, for example, just before the GFC, the cash rate got to 7.25%. And in the mid-90s, the cash rate was 7.5%. Whereas in contrast, the recent peak, at the beginning of this year, 4.35%. So I think what it shows us is because household indebtedness has increased, households are far more sensitive to interest rate settings today. And as a result, the RBA doesn't necessarily need to increase interest rates to the same level that they had to, before the GFC and in the 90s in order to sort of cool the economy. And in fact, if you look at the time-weighted average cash rate over the last 10 years, it's only 2.1%. And over the last 20 years, about 3.4%, which is kind of very close to, where it's sitting at the moment. Now, of course, the COVID years kind of distort those numbers. So if you exclude the COVID years and look at the decade before COVID, 2.6%, still very low. and the 2 decades before COVID about 4%. So you can see that certainly there's a longer term trend of interest rates being on average lower than what they were, say, in the 2000s and certainly in the 1990s. And I think this helps us make long-term financial decisions to kind of understand, what interest rate do we have to kind of make friends with. The next thing we want to think about is what the neutral rate setting is for the RBA. So this is important because this sort of informs us about what kind of the average interest rate is. And then once I've determined what the neutral interest rate is, I then sort of test my cash flow and ask myself, well, what happens if interest rates are 1% above the neutral level? What happens if they're 2% above the neutral level? And just to understand your cash flow sensitivity to potential interest rate changes. And that's how I'd go about sort of planning and working out, is borrowing a certain amount affordable and prudent in my situation. So the neutral cash rate is really just a useful guide because it's neither restrictionary or it's neither contractionary or expansionary. So that is from an economy perspective. It's really kind of is doing neither. Now, the RBA estimates its neutral cash rate is around 2.75%, but a lot of economists believe that it's 3.5%. The truth is it's hard to precisely measure in real time, and the neutral rate can shift over time due to sort of structural factors in the economy as they change and so forth. But I think it's reasonable to expect the neutral rate is somewhere between 3.5%. Now, what we need to then do is add the margin on top of that because, of course, we can't borrow at the RBA's cash rate. The banks need to make some money. So at present, principal interest home loans are typically priced between 2 and 2.5% above the cash rate. And interest-only investment loans are priced around 2.5 to 3% above that cash rate. So therefore, the long-term interest rate that I should make friends with is somewhere between 5 to 6% for home loans on a principal interest basis, or 5.5 to 6.5% for investment loans. And you probably make sense to choose the midpoint of those ranges. And then, as I said, sort of test the sensitivity around your cash flow by adding sort of 1 to 2% to see how it impacts and if it's still affordable. So I guess what we're sort of saying is that whilst we all talk about and hope for interest rate reductions, the current settings aren't too far off what we should consider normal. They're within the range. And therefore, if we are experiencing, challenges, cash flow challenges at the moment, then it could be a sign that you've borrowed too much, or you're spending too much on living expenses, or it's just not right. And so there's a structural thing that needs to be changed there in terms of debt exposure. Really, your borrowing situation should be relatively comfortable at the moment. Of course, the challenge is that you have come off really significant lows in terms of interest rates. You think a couple of years ago, we were borrowing at sort of 2%. So of course, it's a bit of a shock, but we should make friends with the fact that, it's not too far off what is considered to be normal. So fixed rate borrowers, let's talk about fixed rate borrowers and let's look at the evidence, because as you should know by now, I'm very focused on making evidence-based financial decisions. And I think it just helps us avoid making costly, potentially predictable mistakes. Because after all, if all the evidence points to, fixing is not the right thing to do, then you'd be silly to kind of ignore that data. Now, the RBA's tracked 3-year fixed rates since 1990, so that's where this analysis begins. And what I've done is worked out whether fixed rate borrowers have been better or worse off over that particular time. And so between 1990 and 2025, 65% of fixed rate borrowers were worse off. If we excluded the COVID period, because banks at that time were lending to, the RBA was lending to banks during that time at only 0.1% fixed for 3 years. So essentially giving them free money for 3 years. What you would all remember that interest rates, fixed interest rates, were very low at that particular time, two-ish. They even got below 2%. So that's a very unusual period of time. So if we exclude that and just look at, say, 1990 to 2020, which is obviously a 30-year period, 71% of fixed rate borrowers were worse off. The data is pretty compelling that, fixing your interest rate is not necessarily a particularly great idea. Now, if we go back to the 1990s, as I said, interest rate settings were different, household indebtedness was different, the market was different, access to information was different, all those sorts of things. So I think it makes sense to focus on, say, the 20-year period prior to COVID. So let's exclude the last 5 years because interest rates they started that period below average. They went to zero pretty much, the cash rate. And then we've had a substantial uptick. So it's been a pretty volatile period. I think we should ignore the last 5 years. And so if we focus on the 2 decades, say 2000 to 2020, that's, I think, a good period to look at. And so here's what I found. 53% of borrowers were worse off. And of course, therefore, it means 37% of borrowers were better off. Now, you look at that, you've got a greater than, there's more chance that you're not going to be better off by fixing, but it's not as compelling as, say, between 1990 and 2020, that 30-year period where it was 71%. However, the up and downside is the key thing to understand here. So when fixing worked and when you were better off, the average saving was 0.36%, so about a third of 1%. Whereas when fixing was worse off, the average cost was about 0.7%. So when fixing didn't work, which again was 63% of the time, you were 0.7 worse off. 23% of the time, okay, you were better off, but only by a third of a percent. So if you look on a risk-adjusted weighting approach, or basis, I should say, it translates to a cost of fixing of about 0.23% to fix your interest rate. And so I've got all that data, again, on the blog on the website if you want to sort of delve into it. But, it's pretty compelling data. Now, of course, thinking about whether you're going to be better or worse off is only one of many factors that you need to consider when contemplating a fixed interest rate. And there are other sort of structural flexibility, non-financial considerations that you also need to be aware of and also weigh up. So the first one is break costs. And break costs are unascertainable at the time when you enter into a fixed rate. So, if a client asks us, what are the break costs going to be? We say, well, who knows? Because it really depends on how interest rates move after you fix your rate. But the issue is that if you want to break a fixed rate before you finish the term, either because the fixed rate is too high and you want to switch back to variable, or you want to refinance to a different lender, or you want to sell the property, or you want to change your loan structure, something like that. If you want to break a fixed rate, you could be up for substantial fixed rate costs. And I've seen some of these fees, $50,000, that they can be substantial. Essentially what the bank will do, and it's a bit of a black box calculation, which I think the government needs to regulate, improve the regulation around, because we've been through periods of times where really pre-GFC, when interest rates started to really escalate and some clients wanted to break fixed rate costs, you would compare two different break fees. CBA would charge for very similar loans $20,000, and another bank, say ANZ, might charge $5,000. Doesn't matter about the banks. I'm not picking on CBA, but I'm saying that wasn't a lot of consistency. But essentially what the bank says is that they will charge you whatever they lose out by you breaking the fixed rate. So what they'll do is, if you've got on a 5-year fixed rate term, and let's say there's 3 years remaining, what the bank will do is work out how much can we re-lend that money for 3 years, and then they'll charge the difference for a 3-year period. So you're actually better off by breaking the fixed rate. If you're stuck in a fixed rate that's too high, you're actually trapped, because the break fees, will probably make it, they'll be too cost prohibitive to to break that. But the point is that you just don't know what those costs are, and you could end up paying a lot of expense, particularly if you need to change a fixed rate because of something completely unforeseen. That's the issue, right? That we all make these decisions, financial decisions, and we think, oh, no, it'll be fine. I don't expect any changes. But the problem is, from my experience working with clients for many decades, is many changes or changes that happen in our life, a lot of them are unexpected. So we just need to keep that flexibility. The second consideration is that most lenders don't allow you to attach an offset account, a true offset account, linked to a fixed rate loan. There are some notable exceptions in Australia: Adelaide Bank, Bank Australia, and Bendigo Bank. And there might be some others as well. Heritage Bank, I think, maybe. There could be others as well, but there's only a handful of lenders that allow you to attach an offset account. Now, an offset account can be really valuable, particularly homeowners, parking surplus cash in there to reduce the amount of interest that you're paying, of course. And for investors, they can do the same thing while preserving the original tax deductible nature of the debt. So one way to kind of navigate this potential downside is obviously to split your rate and fix some of the loan, and then have some loan variable and attach an offset account to the variable portion. But we just need to think about, if you're contemplating a fixed rate, you need to think about whether your lender allows you to have an offset and whether that's going to be important to you. The next consideration is limited extra repayments. Most fixed rate loans cap the amount of repayments you can make. Probably not a big deal for investment loans, but could be a bigger consideration for home loans, particularly if your goal is to, make accelerated repayments. So the cap, it typically is around $10,000 to $30,000 over the fixed rate term, but you've got to look at the finer detail. Every lender has different rules around that. But again, if you've got a home loan and you want to repay it as fast as possible, fixing your interest rate might not allow you to sort of do that. And lastly, it can reduce your flexibility in terms of the potential to refinance in the future. So it can lock you into a particular lender. The valuation of the property from that lender might be poor, whereas another lender is going to value the property a lot higher. And you might be trapped because of that fixed rate, and then breaking the fixed rate could end up being really costly. So it means that you're tied to that particular lender, that particular lender's credit policies, and that particular lender's valuations for the period, for the duration that it's fixed for. So personally, and also professionally on behalf of my clients, I value maintaining flexibility. As I said, there's lots of things that can change in our life, and many of them can be unexpected or not predictable, from this point in time. So I like to make sure that we can always, restructure loans, refinance, shop some valuations around, keep that flexibility if we want to, and fixing interest rates don't necessarily make that easy. Personally, I certainly fixed a couple of loans during that COVID period. I mean, most Australians did. The amount of fixing that was going on was all-time highs. And that was a no-brainer, right? You fix at 2%, that's the bank's margin, like how much they make on the home loan. It's never going to, even if the cash rate went negative, or maybe negative, the interest rate could come down. But when the cash rate was pretty much zero, you knew that the downside, interest rates were almost certainly weren't going to fall further. So it was a no-brainer. But that is the only time over the last 25 years I've fixed a loan. So I typically prefer variable, and all the data, the overwhelming data, shows that it doesn't make a lot of sense. What I wanted to do now is ask myself, let's look at the times where fixing made sense. So what can we learn from that? Like, will there be a time when fixing makes sense, and what indications will there be that we're at that sort of particular time? So that way I can say, don't fix unless this happens, for instance. So there were two sort of standouts over the last sort of 35 years of times where fixing made sense. Now, of course, the one we just spoke about, from late 2020 to early 22, there were some ridiculously low fixed rates. I think the lowest was like 1.8%, sort of around about that period, that sort of mark. for 3 years. That's probably, and that's, I don't think we'll ever see those interest rates again. And when you look at where borrowers better off, borrowers over that time ended up being somewhere between 2 to 3.5% better off compared to variable rate borrowers. A really unique period of time. Of course, when those fixed rates were offered, it was really pushed out by the central bank in terms of lending money almost for zero for 3 years to the banks. And then the interest rate shock, of course, the RBA was saying back in 22, we're not going to raise rates until 24. And we know that wasn't the case. So a really unique time. The other period of time was between early 2005 and mid 2006. Now, I appreciate there's going to be probably a reasonable cohort of people either watching this video or listening to this podcast that will go, I don't even remember the time back then. Well, lucky I'm old enough to remember on your behalf. So fixed rates at that time for around 3 years were being offered at 7%. Now, you'd probably think today 7% fixed for 3 years just doesn't look attractive. And in hindsight, compared to today, it doesn't look attractive. But what happened is the RBA hiked the cash rate from sort of high sixes to almost, high eights, almost 9%. And borrowers end up being better off in that time. And that was just before the GFC. So that sort of caused the GFC, of course, high interest rates, but that was kind of a pretty unique time. I think in both those scenarios, I don't think borrowers could have reasonably predicted that they would be better off by fixing their interest rates, except for maybe 21. Those interest rates between late 2020 and early 2022, they were a bit of a no-brainer, right? That was really obvious, but the GFC one, I'm not sure that was particularly obvious at that time. So therefore, my conclusion really is that there's only sort of two reasons to fix your interest rate. When the deal is so clearly in your favour, so you've got to have another kind of COVID event. I mean, I don't want another COVID event, by the way, particularly as someone that lives in Melbourne. We've all been scarred by that. So we don't want that. But in that situation, of course, it makes sense. And the second situation would be, if I needed the protection. So if increasing interest rates would place unacceptable pressure on my cash flow, then I should fix. And really fixing, even if I'm going to pay a premium, it's like paying insurance. So for some people, fixing makes sense as a protection mechanism, but the wrong reason to fix is because you think you will be better off, right? So don't sit there and compare fixed rates today and variable rates today because history tells us overwhelmingly that you won't be better off. Now, as I'm producing this podcast, fixed rates are marginally lower than variable rates at the moment. So 3-year home loan fixed rates around sort of 5.5%. Investment interest only fixed rates, 3 years again, 5.3, 5.8%. I focus on 3 years rates because that's the data that the RBA has collected since 1990. But of course, you can typically fix for 1, 2, 3, 4, or 5 years. Banks used to allow you to fix for 10 to 15 years, but they were wildly unpopular products. It'd be a big move to fix for that length of period, particularly around the restrictions that Australian fixed rate products have. Whereas, say, in the US, for example, you can fix for 30 years, but those products are more flexible, so they're not that comparable to what we've got in Australia. So 5 years a fixed rate, I would look at a 5-year fixed rate, but I'd be really careful. I'd have to be absolutely sure it was an absolute no-brainer like COVID. And so I think 3 years is kind of, it's long enough to give you some interest rate protection and short enough not to necessarily forego at least too much flexibility. And so that's why I've sort of focused on the 3-year term in today's podcast. The other thing you need to be really aware of, and this gets proved time and time again, is that interest rate expectations can change on a dime. So that is that interest rate expectations can literally change overnight. And we've seen that recently with inflation data, and we get an inflation reading every month, and we get then related news stories every month of, okay, the RBA is going to cut rates. No, the next month they're going to hold rates. The next month, they're going to increase rates, and we ride this kind of roller coaster ride. But the thing is to realize is that when you're making that comparison between fixed rates and variable rates, don't be swayed by all this short-term noise around interest rate expectations and people guessing what interest rates are going to do, because it can literally change overnight. So you're better off to ignore that. The other thing to think about is that if you're going to fix interest rates, what you're doing is taking an opposite view of the money markets. Now, fixed interest rates are set by international and Australian money markets. So that's just a whole bunch of institutions, very smart institutions that study the market, that trade on a regular basis, taking positions around where they think interest rates are heading. And they're selling fixed rate bonds, buying fixed rate bonds, and that's what impacts the cost of fixed rate products. So therefore, by saying, yes, I'm going to take a low fixed rate, or a fixed rate that's lower than current variable rates, you're actually taking the opposite view of the market. And that doesn't make sense. So it doesn't make logical sense. And in fact, that's why the data suggests that, you're on a risk adjusted basis, you're going to be worse off. So I should mention, lastly, before I wrap up today and get into some Q&A, that some mortgage brokers, and there are an absolute minority, a tiny minority of the market, I hope, might suggest you fix your interest rate because it locks you in. So they get a trail commission, of course, mortgage brokers do, and they might say, oh, well, if you fix your interest rate for 3 years, to their mind, you're not refinancing for at least 3 years, and that locks in their trail commission. Now, as I said, most great brokers won't take that approach, of course, but it's sort of worth mentioning. Okay, for the people listening or watching on YouTube, I'm going to leave it there now. And for the people listening to the podcast, I'm going to get into some Q&A. But if you are watching on YouTube and you've enjoyed today's episode, please subscribe to the channel.